Hello everyone, how's it going? Today we're going to be talking about SOFI Technologies, trading under the ticker symbol SOFI. It is one of the most volatile and, at one point, bullish titles in the stock market during 2020 and 2021. SOFI has definitely been on most people's radars. As one of the more developed fintech enterprises out there, SOFI has accomplished something that most fintech either couldn't or didn't bother to do. They have a bank license. With that key document at hand, SOFI stands as one of the world's most fleshed out and comprehensive fintech companies out there that can actually replace traditional banks. With that being said, the recent stock performance of SOFI followed the market trend overall, downward. Nevertheless, many people are still interested by eventually buying SOFI because it seems to have so much potentials. In today's video, we will take a look at SOFI and try to work out if you should buy its shares. If you appreciate my content, please consider to drop a like, comment, and subscribe to my channel. Also, please check out the links down in the description, as every help is greatly appreciated. SOFI is a fintech company aiming to become a virtual bank for users seeking more functionalities, flexibility, and competitive fees. As people's needs will change over time regarding how and where they have access to their money, SOFI has identified this massive opportunity to do better than traditional banks, offering more scalable and consistent quality of service to its users and clients. Unlike many fintech companies who offer different parts of what a bank actually does, it's worth pointing out that SOFI tries to bring all the services under one single umbrella platform. To optimize the acquisition cost, the company excels in areas of loan refinancing, personal banking, and wealth management. It has been recently under some selling pressure due to the student loan moratorium as well as the overall environment. With that went most of its gains throughout the bullish period. However, it should be mentioned that despite the challenging environment of the economies around the world, there is not just bad news for SOFI. On one hand, people are more aware of the financial fees that traditional banks are charging, and many are looking for alternatives given that a recession forces them to cut spendings. SOFI might be one of the companies that can satisfy this need for better fees. This might be one of the reasons why, despite having a challenging investment environment, SOFI still manages to see that its customer deposits is going up. Another factor to consider is the ongoing QT, quantitative tightening, and the inflation. As the inflation increases, the yield of assets will go up, increasing the bank's profits overall and decreasing somewhat their risks. After all, the purpose of a bank is to make money with other people's money, and the current environment allows this in certain circumstances. Overall, SOFI has been growing on a year-to-year basis, although the progress certainly slowed down in recent months. This might be caused by the economic downturn putting pressure on all businesses. Despite having an unfavorable headwind, the fact that they still manage to grow is the proof that their brand is solid and that it still manages to attract people. Now, due to regulatory and economic reasons, SOFI saw its student loan and home loan amounts decreasing by 51% and 73% respectively, but this has been compensated by the fact that personal loans increased by 71%, resulting in an overall increase of lending on a year-to-year basis. SOFI has been hovering around $5.50 during today's trading session. Overall, SOFI has been holding decently given the circumstances, as the recent period didn't treat the title very well. There are a lot of speculations around the company suggesting, or rather hoping, that 2023 can be a year of recovery and even glories. But I personally think that we are too soon in the process to tell whether it's going to be an amazing year or not. What I know is that the market is currently in the belief that the company's share price has fallen too far too soon. Therefore, it may not be the beginning of a full-on recovery, but the refusal to go any further down. Nevertheless, I believe that the region between $4.50 and $5 to be a zone of strong support. What is your take on the company's short-term perspectives? Do you intend to increase or to decrease your position in the short-term future? Please let me know down in the comments section. The long-term stock performance of SOFI has been like every single other title on the Nasdaq, disappointing. The stock has been down by 70% since the beginning of the year, mainly caused by the moratorium of the student loan. The information that is currently available suggests that this moratorium would be lifted very soon, meaning that there will be additional needs of businesses regarding the student loan in the years to come. With that being said, it's worth mentioning that personal loan has already filled the gap left by student loan, so this will be just another layer of cream or just cherry on top. What also brings down SOFI, and arguably keeps it down, is the fact that it is a very small boat in an ocean of bearishness. The Nasdaq, much like other major indexes, have now lost most of the gains made during the period of 2020 and 2022. This means that the market has now come back to the predictions by the end of 2019 regarding the world economy, which was already anticipating upcoming recessions, but without the worries of inflation and armed conflicts. This is why the probability of entering in a recession in 2023 and beyond is high. That would bring the valuation of many securities even lower. So basically, what is ahead for SOFI is the possibility of a partial recovery of the student loan business, but also a market-wide pressure due to the economic weaknesses across the economies. With that being said, SOFI fell so much compared to the rest of the market, so I don't believe that its price is going to keep falling like this. With that being said, let's also take a look at the company's fundamentals and see what they tell us. Regarding the profitability, SOFI has a net loss from the operations if we get in the non-cash transactions and the non-operating expenses, mostly interest expenses and amortization. On the other hand, SOFI is yielding positive gross profit that grows across the past quarters, definitely something that is very encouraging and showing the validity as well as the scalability of its business model. The one challenge that SOFI should address is the cost control, especially when it comes to operating cost. I expect that the spendings will be eventually get under control, but for now, I believe that they will still emphasize on the growth more than the bottom line. Another aspect that's very important is the leverage. SOFI has a high level of leverage accumulated over the past few quarters, meaning it is relatively normal given the industry the company operates in. Nevertheless, we should be aware that the current level of debt may cause some issues down the road, which is already showing from the equity perspective because it has been reducing over the past 3 quarters, a sign that the funds borrowed haven't been used for maximum efficiency, and they have been borrowed more and more. The third aspect to look at would be the cash flows that the operations bring in, and in this aspect, SOFI is doing a good job. The free cash flows as well as the cash flow from operations are positive, so the company can self-sustain in terms of cash reserves, bringing down the possibility of additional dilutions. When we take a look at the company's ratios, we can see that the company has been lagging behind in valuations. At the same time, I would say that the company may not be growing as fast as it should be because of the unfavorable market conditions. So we should be aware that SOFI is losing value on paper, and we should see whether the situation can sustain and rectify itself eventually in 2023. Regarding the company's profitability, the numbers are showing that things are being stabilized, and from some perspectives, even going above the break-even line. So we should definitely see whether this can improve in 2023. Hopefully they can. Now, let's also take a look at the shareholder composition, which can tell us whether the stock is molded for trading or investment, as well as the volatility of the stock. SOFI is owned by institutions for up to almost 36% of the current float. This is significant, but also showing that the vast majority of the shareholders remain retail. This means that SOFI has a fairly volatile shareholder base, tend to trade in and out of positions based on rumors and short-term sentiments. So even with 36%, I believe that investing into SoFi is a good idea. We should also point out that around 38% of the stock is owned by insiders, offering an additional layer of reassurance. One key behavioral difference between institutional and retail traders is the investment horizon. So in this case, they can afford to play the long game because their holdings are so massive and diversified that one stock is not going to do much. So they can afford to wait a pretty long period of time and to weather the storm once everything is behind us. On the other hand, the retail traders tend to focus a lot more on the short-term gains and are more likely to make decisions based on the market sentiment and news. This may lead to more active buying and selling and can result in higher volatilities in the stock price. Another behavioral difference is that institutional shareholders tend to be more active in the governance. On the other hand, the retail is far less likely to actually go to vote, to talk to the management, and so on. As far as the short sentiment is concerned, SoFi currently has about 12% of the volume going short against it, with 2.4 days to be covered. This is a significant amount of shares to be sure, but I don't believe that this is worth our time to say that this is one of the main catalysts to buy SoFi. It's very important to note that short interest is not a guarantee for a short squeeze, but it's a metric worth monitoring for investors. It's also worth considering that short sellers may have valid reasons for their bearish sentiment, and a short squeeze may not happen. I believe that SoFi is a stock in which we should invest in, meaning that the short-term volatility is meaningful to the extent that it can provide us better entry points. In the meantime, I think that the current price is low enough for an initial entry, with the remainder of your allocation to be reserved for the next 3 to 6 months. The maximum exposure I would recommend for SoFi is between 3 to 5% of your portfolio.